In his book, Money, Master the Game, Tony Robbins tackles the misleading ways investment returns are often reported. Financial institutions tend to showcase time-weighted average returns, which can paint an overly optimistic picture of performance. However, Robbins urges investors to focus instead on dollar-weighted returns, which reflect the actual experience of real investors, factoring in contributions, withdrawals, fees, and the timing of market movements. And here's the problem. Average returns don't account for volatility. Imagine a fund that loses 50% one year and gains 50% the next. The average return appears to be zero, but in reality, the investor has lost 25% of their money. This is because a 50% loss on $100,000 brings the value to $50,000. A 50% gain on that brings it only to $25,000, not back to the original amount. Robbins also emphasizes how performance reporting often ignores fees and taxes, further distorting reality. A fund might boast a 10% return, but after management fees, trading costs, and taxes, an investor might net only 6%, a significant difference over time. In truth, what looks like a great return on paper often doesn't translate to actual wealth gains. Another issue is performance cherry picking. Fund managers might advertise their best performing funds and conveniently omit underperformers. Worse still, firms sometimes launch many similar funds, knowing a few will outperform by chance. They then promote those few, creating the illusion of consistent success while ignoring the failures. Robbins highlights that most investors don't even achieve the reported returns of the funds they invest in. But why? Because they buy high and sell low, reacting emotionally to market swings. This behavioral gap means investors often underperform their own investments. The solution Robbins proposes is greater awareness and skepticism. Don't be swayed by impressive-sounding average returns. Ask about net returns after fees and taxes. Understand the real impact of volatility and how your personal behavior affects the outcomes. Use tools to calculate your personal return rate, what Robbins calls your real return, which reflects the money you actually pocket, not what the marketing brochures say. In summary, this myth warns against taking reported returns at face value. What you see is rarely what you get. By learning to read between the lines and by focusing on real net returns, especially those that factor in your timing, fees, and emotional decisions, you can make far smarter investment choices. Robbins' advice is clear. Be less impressed by flashy numbers and more focused on what actually builds wealth over time. Thanks for your time, and until next time, be well.